Using SPACs to take private companies public was all the rage on Wall Street starting in 2020. The market was booming, and it's a fast-tracked way to avoid the IPO process. But it sure didn't mean those companies would be successful. Here are some of the most disastrous SPAC mergers in this week's Buy for Friday. With the pandemic came the home fitness craze. Beachbody tried to ride the Peloton wave with a SPAC merger with Shack-backed Forest Road Acquisition Corp. But the company quickly became another casualty when gyms opened back up, its stock on a steep decline. At this point, celebrity-backed SPACs had become so common, regulators felt forced to spell out it is never a good idea to invest in a SPAC just because someone famous sponsors or invests in it. Number 4 brings a celebrity president into the mix. Trump Media and Technology Group joined the blank check boom with plans to merge with SPAC Digital World Acquisition Corp. Supporters bought up shares before Truth Social even had a product on the market. And now the SPACs plunged nearly 70% after investors learned the SEC is investigating the merger. Number 3 is a real buzzkill for other digital media companies looking to ride the SPAC train. Buzzfeed, the site that brought you 15 hedgehogs with things that look like hedgehogs, was hoping that going public via SPAC would help raise dough to buy up other sites. But their CEO said they saw the SPAC market get ice cold during the process. Buzzfeed's stock has dropped more than 80% since December. Number 2 shows a lot of chatter doesn't mean great returns. You can't get through the holidays without someone talking about their 23andMe kit. That's why it went public with billionaire Richard Branson's SPAC with a valuation of $3.5 billion. But a series of poor earnings outlooks made the stock tank more than 70% since its inception. View Inc. makes smart windows that auto-tint, so you don't need blinds. Sounds pretty great. That's why they entered a $1.6 billion SPAC merger. But View burned through $2 billion since getting off the ground, and it costs more to make the product than they can sell them for. One of the many reasons it's down more than 80% since the SPAC launch. If there's one silver lining, at least these SPACs made it to merger. There are tons of empty shell companies still out there that haven't. And if there's no deal in 2 years, it's all for nothing. But at least those shareholders will get their money back over losing it in the market. That's your Buy for Friday. I'm Simone Del Rosario for Just Business. Have a good weekend.